Welcome to the Accrued Interest Podcast. I'm your host, Simeon McMillan, and in this video, I'm going to explain how my stock pitch won the 2013 Ira Sohn Investment Idea Competition. First, a brief disclaimer. The information presented on this podcast is for educational purposes and should not be construed as investment advice. Investors should make their own decisions regarding the prospects of any company discussed on this show. Back in 2013, when I was a graduate student at Columbia doing my MBA, I won the Ira Sohn Investment Idea Conference. This year, 12 years later, marks the 30th annual New York Sohn Investment Conference. Each year at Lincoln Center in May, the conference brings together the world's top hedge fund managers to share their market insights while raising money to support pediatric cancer research initiatives. The conference typically holds a competition where they collect blind submissions from investors, both professional and amateur, to pitch their best investment idea so they can then present on the big stage in New York City. Since there's no competition being held this year, I'm going to use this opportunity to go over my pitch that won the competition back in 2013. The company I selected was Tribune Broadcasting. This is the roadmap that I gave the audience for the presentation. First, I want to discuss some upcoming asset sales that the company had announced of its newspaper assets as well as its stake in the Food Network. Next, the broadcast television assets and their cable assets were undervalued. And I'll bring it all together with a valuation that shows there's sufficient margin of safety from where the stock was trading at the time. If I had to give tips on how to win stock pitching competitions, your best bet is to read the classic book by Joel Greenblatt, You Can Be a Stock Market Genius. Tribune was a quintessential special situation stock for the following reasons. First, the stock was coming out of bankruptcy. There was limited sell-side coverage from the research community, so many were not aware. The company was not recent with its SEC filings, so we had to do some work to analyze the opportunity. At the time, the stock was traded over the counter, that's OTC, also known as the pink sheets, where it doesn't have as much liquidity as if it was on the NASDAQ or the NYSE. The company had just completed a major corporate restructuring following their bankruptcy, and media at the time was undergoing changes, and I argue was a misunderstood industry. Also coming out of the bankruptcy process, Tribune had an underleveraged balance sheet that was an opportunity. There was a new management team that was ready to get started, and I laid out multiple catalysts to drive value so you're not waiting forever. This high level is my sum of the parts valuation that gives the audience a preview of where I think the value is to come. I argued up front that the stock, which was trading at $55 a share, had a valuation range anywhere between $58 and $113, from 6% to 106% upside. I start my presentation with an overview of Tribune's media assets. Tribune still owned the Chicago Tribune, the Los Angeles Times, as well as 8 regional newspapers. They had a portfolio of 23 broadcast television stations. They also had a basic cable network, WGN America, which we'll get to, and a host of minority investments. Tribune had about 31% stake in the Food Network. They owned 31% of the website Career Builder, and they owned about 28% of a company called Classified Ventures. Classified Ventures had listings-related businesses, such as Apartments.com and Cars.com. Now let's talk about the assets that I think can be sold without affecting the core operations. An auction was currently underway at the time of my pitch for Tribune's newspapers. The company announced they had hired investment bankers to run a formal auction process after receiving unsolicited bids. Newspapers at the time were profitable for Tribune and had 2 crown jewel assets whose value was hard to measure. That's the Los Angeles Times and the Chicago Tribune. Ideally, the company wanted to sell to one buyer, but several billionaires back then expressed interest in owning these assets. Upon merging from bankruptcy, Lazard was hired to conservatively value the publishing assets at about $623 million. That was about 3.2 times 2012 estimated EBITDA. I argued a $1 billion bid was possible given the trophy nature of some of the marquee newspapers. $1 billion would still only imply a 5 times trailing EBITDA multiple, or about $9.90 a share. I assumed that publishing revenue was still in decline, and then I applied a lower than average 10% EBITDA margin to get an estimated 2012 EBITDA of $196 million. Next, I talk about the real estate. The commercial real estate brokers, Cushman & Wakefield, had evaluated the company's real estate portfolio. In the bankruptcy documents, they estimated that Tribune could earn anywhere between $444 million to $504 million with a sale-leaseback transaction to monetize the real estate value. That equated to about $4.40 a share to about $4.99 a share. I argued at the time that these valuations could prove conservative because this was 2013. We were still coming out of the great financial crisis. The real estate market was still recovering. It's possible, over the course of liquidating these assets, the real estate market could continue to rebound higher than what was done at this valuation. Following the sale of the newspapers, Tribune was likely to look to sell its 31% interest in the Food Network back to its majority holder, Scripps Networks Interactive. The Food Network was arguably the best property within Scripps' portfolio. It had the second highest affiliate rate per subscriber, the highest viewership in the 18 to 34 viewing demographic, and a portfolio-leading EBITDA margin about 64%. That was higher than the approximately 51% for the rest of the Scripps portfolio. Here's my valuation for the Food Network stake. Consensus was that Scripps could pay up to $2 billion or $20 per Tribune share. In this table, I listed the expected revenue and EBITDA contribution from 2010 to 2012. I listed it with the other cable networks owned by Scripps, such as HETV, the Travel Channel, DIY, Do-It-Yourself Network, the Cooking Channel, and Great American Country. You can see that the Food Network comps very well against these other assets, and it made sense that Scripps could consolidate it at 12 times EBITDA, which was close to the multiple that it was trading at the time. Now let's talk about the media assets, starting with the broadcast television stations. I said on stage in Lincoln Center that the death of broadcast television had been greatly exaggerated. And in 2013, that was true. Broadcast television stocks had been on a tear. You can see they were up on average 163% over the past year. That blew away the S&P 500, which was up about 18%. I argue that Tribune is worth a buy because its stock could ride this wave. Back in 2013, cord cutting was still in the mind of investors, but it was really different from 2025. Investors were a lot more optimistic on television. It was thought that broadcast television would be able to avoid the declining fates of the newspaper and radio industry. Broadcast television was increasing its share of local advertising spend. Automotive advertising made up about 25% of industry advertising revenue, and the ad spend per new vehicle sold was anywhere between $575 to $635 per vehicle, of which about 50% of that went to television. I went back 13 years. Television was actually still growing its share. Tribune and local broadcast television was a play on rising ad spend for local automotive sales. The number of total new vehicles sold was still rising coming out of the recession and the slow motion recovery. I argue that in a fragmented world, broadcast TV had value to advertisers because no other medium could aggregate an audience like broadcast TV. The evidence that I used was the fact that broadcast garnered a premium CPM, that stands for the average cost per thousand impressions, to reach their audiences when advertisers went to buy ads. According to Morgan Stanley research in 2012, broadcast earned an average CPM of $16. That was almost double the $8 CPM for cable and far higher than we were getting in digital back then. User-generated online video was getting about $3 CPMs. Yahoo Display was around $1 and Facebook was at 20 cents. Aggressive consolidation was underway in television. TV station multiples back then had been on the rise as larger public companies were rolling up the industry. SNL Kagan reported at the time that in 2012, 58 television stations sold for a total of over $2 billion at multiples between 9 times to 11 times broadcast free cash flow. That trend carried over into 2013, with Sinclair Broadcasting alone acquiring combined 42 stations for $842 million. Tribune had stations in some of the largest markets. On your screen here, I laid out some of their top stations and top markets to show that they had a strong reach that other companies would want to add to their portfolio. Tribune had stations in 7 of the top 10 broadcast markets, with stations in New York, Los Angeles, Chicago, Philadelphia, Dallas, Washington, D.C., and Houston, Texas. Because they had so many stations in the biggest markets, were able to reach 36% of the U.S. population, despite having 23 stations in 17 markets. In comparison, Sinclair had 134 stations in 69 markets, but still only reached 34% of the U.S. population. Next, I argued there was upside for Tribune if they were able to increase the earnings potential of their basic cable network, WGN America. Back then, full penetration for a basic cable network meant 100 million subscribers. WGN America was currently in about 76 million households compared to over 100 million for TNT, TBS, FX, and USA. WGN America was earning about 19 cents per subscriber from their affiliate deals. There was room for upside. TNT, which admittedly was sports-centric, was getting about $1.18. TBS, FX, and USA Network, which were much more entertainment-focused, were earning anywhere between 48 cents, 56 cents, and 62 cents per month per subscriber, far higher than the 19 cents WGN was getting. If you thought they could raise their rates, you could see that their free cash flow and the free cash flow margins could go a lot higher. At the time, part of the bull case for Tribune was that they had a new management team led by a CEO named Peter Logori, who was a proven cable operator. He was credited with turning around the FX cable network into a programming powerhouse. Peter was president of FX back in 1998, when it was a small basic cable channel that was mostly airing reruns of everything from MASH to Buffy the Vampire Slayer. It was during that time that FX started doing original programming such as Nip Tuck, Rescue Me, and The Shield, and that raised the monetization and the profitability of the channel. I argued that this was possible at WGN America as well. I explained how Tribune had filled out their executive ranks with executives who had proven track records at companies such as Fox, Warner Brothers, NBC Universal, and others with broadcast local market experience. This is where I laid out the math of how a turnaround at WGN America could play out in the numbers. In 2016, I estimated WGN America could raise their distribution footprint from about 76 million households to anywhere between 80 to 90 million households. I also argued they could more than double the affiliate revenue per sub as well as the net advertising revenue per sub. And in 2016, the future value of the WGN turnaround could be worth anywhere between $23.47 a share to as high as $55 a share. This was a wide margin of safety. Next, I want to talk about how the broadcast television assets were also being undervalued. The broadcast stations were worth about $22 a share. That's 10 times the 2012 trailing EBITDA. Status quo WGN was worth about $18 a share. And after the changes, new original programming, getting higher rates, I argued could be worth about $37 a share. This was my final valuation slide where I argued that Tribune trading at $55 a share had a base case of about $88 a share. That's upside of about 60%. I wanted to show that a conservative value investor could take the different parts, the minority investments, the assets for sale, the real estate, the newspapers, as well as the upside for the remaining TV, cable, network, and broadcast operations, and you can see that this was a very undervalued security. Lastly, I wanted to show the investors there was urgency to the pitch. So I laid out the catalysts and how I thought they would play out. Tribune was about to file its financials with the SEC. They had last given financial updates in 2011. Investors would be able to get a sense of how the company was doing when they moved from over-the-counter to a major exchange. This would add additional liquidity and bring more price discovery to the stock. And long term, since Tribune was a media conglomerate, I thought that it had the potential to be added to the S&P 500, similar to other media companies at the time. Thank you for listening to this pitch. If you enjoyed this content, I recommend you come to my Substack where I have deep dives on this investment as well as more current investment pitches. My Substack is accrued interest, one word, .substack.com. And if you found this entertaining, please subscribe to my YouTube channel. You'll see videos on all sorts of media topics this Q1 earnings season.